Hello, everybody, and welcome to VRIC Media, the most trusted voice in junior mining. The Vancouver Resource Investment Conference has just wrapped up. We will have video from that available soon on this channel. But of course, we are bringing the VRIC to you with our series of expert online panels. We have an incredible one for you today for those interested in the uranium sector. We've got Mike Alkin, founder and chief investment officer of Station Cove, and Justin Huhn, founder and publisher of UraniumInsider.com. I cannot think of a better dream team to bring together to discuss the uranium sector. Gentlemen, it's great to have you on the show.
Thanks for having me, Jesse.
Yeah, thanks so much, Jesse. Very honored to be here.
Well, let's start with a broad question. You can feel free to take it wherever you'd like. What are the main themes and trends that you're currently watching as we sit here today when it comes to the uranium sector that you think more investors should be paying attention to? And Mike, I'll start with you.
So for me, it's pretty boring, Jesse. It's more of the same. Going back many years now, we started looking at the sector late 15, 16, 17, and started investing in it really 18-ish, 17, 18. It was about simply the price of uranium had declined to a price where there was not enough economic supply to meet future demand, which was de minimis at that time. Once contracts, which covered at much higher pricing at long-term deals, once they started rolling off and producers were exposed to the spot market, which at that time was $18 or so, and it cost them in the mid-50s to extract it on average around the world, that you would have to see supply discipline, and that came. But at that time, there were no Herculean assumptions at all. Like I said, 30 countries produced nuclear power, the big five at the time, the US, Japan, Korea, the French, they were all in the UK. They were all starting to nuclear was fading a little bit. It was not a big decliner, but the growth was coming from Asia. But if you did that math, you could say it was very modest growth at all, if any at all. But when you did that math and you looked at the uncovered requirements that needed to be contracted for, with supply coming offline, it was a very compelling argument for prices to have to move materially higher, at least certainly far greater than their all-in sustaining cost in the mid-50s. So where that price was, who knew? But it was, 75, 80, 85, 90, 100. You don't know. The market would figure that out, but it had to move up a lot. And you've seen it move up a lot. Since then, over the last 5 years, certainly something I didn't predict, and certainly something that we don't use, is a resurgence in nuclear. All the big five who were fading are now reinvigorated. There's a rejuvenation around the globe. It's become somewhat bipartisan in support of nuclear because it's clean, it's reliable, and all that stuff. So you've seen a growth profile that's grown exponentially. And then on top of that, you've layered in stuff that we don't particularly use in our models at all, which is AI and data centers and SMRs, and all. That's all futuristic stuff. But the very case of it is there's not enough economic supply. And I know at times it doesn't feel that way because the equities will bounce around, the pricing of the spot market will bounce around. But the key indicators of value creation in the industry, which is the long-term contract price, continues to move higher and higher for the last several years. And even in a year like 2024, where the contract volumes were down somewhere in the 30% range, the term price of uranium, the contract price of uranium, was up almost 20%. So that doesn't really happen in a commodity where there's not stretched supply. If something's down in volume, it would stand to reason pricing would follow. Here, it's just the opposite. So as in terms of what looking for, it's more of this, it's just more patience on the supply side. But, the things that are out there that you look at is, shipping coming out of the east, coming out of Russia, right? They go through the port of St. Petersburg. That's been challenged. They're having to use alternative ports. That's a challenge. There's Russian bans of uranium that go back and forth. The Russians are banning, or the U.S. is banning Russian uranium. The Russians are saying no uranium for you. Obviously, that's something that's challenging, which leads to the risk of enriched uranium not winding up here in the United States or Western ports where you need it. The other thing I think that stands out is you've seen some really difficulties in mine restarts. A lot of mines have, some mines have started to come on. It's been very challenging to get back to where the production levels they are. And then also just new mines, we're watching closely. We see a lot of mines with forecasted start dates that are being pushed out to the right and some that are just probably not realistic. So those are kind of the things we look at.
And Justin, what are you watching right now in the uranium sector you think more investors should have their eyes on?
Well, I think regardless what Mike or I answer to this question, investors are going to continue to just watch the spot market. That's
Yeah.
that's pretty much all they ever do. And luckily for them, we're probably going to see that move, and probably going to see that move soon. It eventually will, over time, relatively track the term price, which is the real price, and it'll make overshoots, and it'll come back and pull down below, and when demand isn't there in the market, but the term contracting market is telling us everything that we need to know about the direction of this trade. So you see not only just the consistent rising and stable price in the term market, kind of just quietly in the background as spot launches and falls back down, term just keeps kind of chugging higher. When you hear metrics of the contract pricing terms leak out into the market, and of course, the most recent and obvious example of this would be the contracts that NextGen signed last month with multiple major utilities in the United States for 5 million pounds is not a lot relative to the production that they have in their feasibility study that is proposed. But the metrics were $79 floors and ceilings pushing $150 a pound. And this is with delivery 5 years from now, 4 years from now. So those ceilings are protecting the buyer from paying more than what both parties believe the pricing environment could be at the time of delivery. So these metrics are telling you exactly where the buyers and the sellers believe that the price is going. And that's not theoretical. That isn't something that investors are hoping to see in the future. These are the actual end users procuring and the producers of the material or to be producers of the material that are selling material saying, this is the environment that we're willing to sign. So that's a huge signal. And then of course just the elements of the contracts with flex provisions going away, with the contracts being largely referenced to the market, if not entirely referenced to the market. It is a full-on seller's market, and there's no sign of that changing anytime soon. So that's what we're watching more than anything. There's a bunch of other nuances. And then just to echo what Mike said, supply is and always will be challenged. Mining is really hard. Uranium mining is the hardest, arguably, for obvious reasons. So challenged supply, de-risked and growing, stabilized growing demand. It's kind of a commodities dream scenario, really.
Well, we have seen sentiment in the sector be very low if we're looking at social media as any indicator. In fact, over the past several months, maybe starting back around 6 months ago, you started to see this sentiment on X in particular, where people were throwing in the towel or people saying, I'm too underwater to even be able to throw in the towel at this point. I just need to break even, which is kind of an insane thing. I think that's people deploying capital into companies that just don't have any great prospects. Everybody out there is dreaming of 10-bagger returns, visions of sugar plums dancing in their heads when it comes to this sector in particular. But we've seen people be very angry, frankly, on social media, stating that the thesis isn't working out the way it's supposed to. Why aren't the equities going up? Is this ever going to work out? Uranium's a dead sector. You can add any other number of statements to that list. I wonder what both of your thoughts are here on just a general investor sentiment you've also seen. Obviously, you're operating in very different worlds than this small cabal of people on X. I've even heard cries that the uranium price is manipulated, even, which is kind of amusing. So where do you both stand when it comes to sentiment in the sector? What would you say to those people who are proclaiming that the thesis is dead? And Justin, I'll start with you on this one.
I would say if they're proclaiming that the thesis is dead, they're probably just not doing very much work in the sector at all and not really understanding the fundamental dynamics of the fuel cycle, which tell you exactly where this is going. It might not tell you where the price is going in the next week or the next month, but for us, just capturing the overall trend for a long-term period of time is what we're attempting to do. So we're going to have very emotional and volatile cycles within a long-term secular bull market, and we are absolutely still in a long-term secular bull market. Those cycles will swing for whatever reason. There are very emotional investors in this particular sector. Maybe it's due to the volatility. But since I've been watching this market, every single time since we have entered into a bull market, every single time that we have SPUT pushing a double-digit discount to NAV, when we have RSI for the ETFs below, let's say 30, and sentiment is really terrible, that's been an excellent time to add to longs. Now, of course, trading out when the sentiment is opposite is also a challenge. But for us, we're going to see swings in sentiment. And there was a really excellent thread on X last month from Kevin Bambro, former CEO of Sprott, where he talked about, emotions playing a role in his investment journey, really. And so at some point, with a certain amount of experience investing in resource sectors, to speak generally, you actually end up having not to trade opposite your emotions, but you have the emotion that you should have for these particular cycles in a resource sector. So to say that when sentiment is really poor, when the equities are doing a nosedive, and there's a lot of fear and there's a lot of panic selling, instead of feeling that and forcing yourself to trade opposite that, you actually end up having the emotion of greed and of hope and of optimism based on that. And part of that is understanding and having confidence in the long-term fundamental nature of this sector. When the market gives you these opportunities of terrible sentiment and the equities are pulling back, and you know exactly why the spot price is pulling back, and we do, then you can take those opportunities to add to longs, to take new positions, whatever it might be. So for us, the sentiment lows that go in cycles, you have to know what's happening in the background. You have to know what's going on in the physical market. If you do, they're very easy to weather, and the sentiment that you see in social media is one part of those indicators of the lows of cycle pullbacks, which I think we're starting to come out of.
And Mike, what are your thoughts? And also, I'd like to pose the question from your point of view, who do you think are the majority of the participants currently in the uranium market? Is it mostly retail investors? Is there a decent amount of institutional players involved? Who are the market participants?
I mean, I think I don't really know. I'm bad at this. I don't pay much attention to it, so I don't know. I haven't been active on X in years, so I don't really know. But I can tell you from my perspective, from an institutional standpoint, I presented at the Goldman Sachs Energy Conference last week, and there was a mix-up, and rather than me. I wound up in a meeting room with a bunch of other funds that were there, and they were there to meet me, and I didn't sign up to meet with other funds, but somehow I wound up in a room with a bunch of hedge funds for a few hours, and I had really no interest in talking, but we were there. They were nice guys, and we sat and chatted, and and I talked to investors throughout, over weeks and months. Everyone has different views and expectations, their own theses. And so I go back to, at the end of the day, I know that the spot market is 15 in a good year, in a big year, 20% of the overall volumes. Those are numbers, those are hardcore, those are facts over time. So I look at that, and I look at that, and I look at what drives value in the market. It's term contracting. We are out, as Justin referenced earlier, talking to people. We live in the physical market. We're talking to traders. You're talking to utilities. You're talking to brokers. You're talking to people who are engaged in it. And so we see the small portion of the market that is a very minor portion of the market is where all the attention is focused. I don't know, and I can't try and figure out how to work in that. So I choose not to. I'm aware of the spot market. I'm aware it's there. I'm aware it's an important indicator for people. It's not that it's not important. There are some contracts tied to it. But what I look at is, at the end of the day, is what I said earlier. is if 80%, 85% of pounds that transact in a given year occur in a long-term contract market, and the fuel buyers are stepping away as they are temporarily because they don't like the price, and volumes are down in that market 30-ish% this year, the price is up 20%. So they can run, but they can't hide. And so at the end of the day, those who are testing the economic viability of available pounds are finding there's not enough of them. So that to me is where I know creates the value. Now, I do have great empathy for somebody who thinks they're going to come into this trade because uranium is going to double or triple over a short period of time. Or, one of the things earlier in the spring you saw was a lot of excitement around data centers and AI, right? And let's not forget, and I mean, I know my knowledge of technology could fit on my pinky. So I'm not a technologist. I don't really claim to know any of that stuff. I believe them when they say AI and data centers consume so much more power. Great. But when you see the big tech companies signing deals with some of the nuclear plants or the SMRs and AI and big data is coming, well, Wall Street's going to rally around a theme and they're going to get really excited. That's what Wall Street does. Wall Street rallies around themes. They need them to go package them. Think of the BRICS. They package them and then go sell them, sell excitement. And so, you take earlier in the year when all of this nuclear stuff was happening with big tech and uranium stocks were absolutely ripping. Well, I know from studying the market for a number of years and being an active participant in the market, the price of uranium, that is the spot market price that people turn their attention to because it's reported once a day and throughout the day from the brokers put out prices, that the people buying and selling that could not care less about data center deals being signed. It's irrelevant to them what happens 3, 5, 7 years from now. The trader, right, understanding market structure, the person who is buying those pounds is if you think about the spot market, 70% of those pounds transacted roughly are financial intermediaries swapping pounds back and forth, right? Utilities are a very small portion of that, as are producers. So they don't care about the price of uranium. So what winds up happening is the stocks start taking off. People jump on the theme and say, my God, look at this. These stocks just were up X%, a big move because data centers are here. And then they pile in. And then sure enough, what happens over the next weeks and months, the price of uranium, the price, what's the price, right? The price, the spot price that people stare at is backing off. Because for whatever, there's a little excess in the spot market, which has nothing to do with contracts, which is where utilities need security of supply. And the stocks then sell off. So if one is inclined to get their cues from price movements to get conviction, this is a tough trade, right? Whether it's retail or institution. When I sat with these funds for several hours talking to them, they're focused on things that aren't going to create a lot of value in the long term. And you'll talk to them about contracting and all this stuff, and they'll be like, yeah, right, why did the price go down today? And you're like, okay. So they're the same. And if you're running a fund, right, if it depends on your fund structure, you have weekly, monthly reporting requirements. It's tricky to weather these storms. So yeah, I empathize. It just depends. If someone has a longer term time horizon, it's probably a good place to be. If it's more shorter term, it's a tough investment because the volatility is very prone to subject to sentiment shift. And the last thing I'll say is, this isn't like looking at small oil and gas producers in Canada that all are generating mountains of cash flow. Even if the price of oil is fluctuating all over the place, you've got company, they have capital return programs, buybacks, they could pay dividends, they could do all sorts of stuff, but there's something underneath it. Many of these companies, it's all on the come. Not all of them, but many of them. And so that's hard for people when the only thing they can look at is the spot price. So it is. I empathize, and it's tricky. I mean, I have the conviction that longer term, it is what it is. And I don't, we've been in this investment since 2018. It's worked out pretty darn well, and more than that. So you have periods of ups and downs. If you come in towards a big rally, there's a chance you're going to be part of that 2 steps forward, 1 step back camp.
Yeah, great breakdown from both of you. I want to discuss the ban on enriched uranium from Russia coming down on both sides, as you mentioned, first from the US side, and then Russia said basically, you can't fire me, I quit, implemented a ban on their side as well. Could you break down how this will affect the uranium market? Because I think a lot of people don't really understand the conversion and enrichment side of things and how that plays into the final price of uranium. So if you could explain how this ban could potentially affect prices. And then as an aside, do you think Trump coming into office, do you think there's a chance he might reverse this ban? And Mike, I'll start with you on this one.
So, again, when you hear about the bans, so the United States Congress enacted a ban of Russian uranium starting in a few years. And there are some waivers that can be had. Because the U.S. receives 25% of their enriched uranium, because uranium by itself can't do anything for the most part, unless it's one of a handful of reactors in the world. For the most reactors need to be enriched. And so Russia has 41% share of that market globally. So when they banned it, you're dealing with waivers that could be had. If you had a best efforts, you'll be able to get a waiver. But again, this isn't a market where a headline hits and that fuel buyer runs out and does something and says, oh my God, they knew they saw it was coming. They know it's coming. They start to prepare for it. Yeah. And so where these things trigger, it's the marginal buyer that triggers this. So if you're looking at the major utilities, Duke, Constellation, PSE&G, the Southerns, the big ones. When you're looking at the big ones, they're well covered for years, right? You're talking very sophisticated buying organizations. They're smart, they're shrewd. Can they like anyone? Can anyone be a little offsides? Yes, but for the most part, they're covered. It's the 1 or 2 reactor. It's where there's 1 or 2 reactor and somebody wasn't paying attention to the rubber band being stretched so far that an enriched uranium shipment comes or can't come in, because we've seen a few where they've left the port of St. Pete without any enriched uranium on them, because the Russians in reverse said no uranium for you. But there are ways to mitigate that. Utilities could swap amongst each other, right? You can work around. So it's not this immediate impact. It just kind of grinds away, and then it's that marginal buyer who's hosed, where they can't get that swap. They can't get a loan. They can't a loan for material. And then it happens. So always trying to identify the catalyst that triggers that is really hard, but knowing the conditions that trigger that is what we focus on. So yes, the Russians, we have banned that in 27, that's well known. Yes, the Russians have said no uranium for you. There's a little floating around. So if the last couple of shipments that have left St. Petersburg without enriched uranium, it's covered for right there. But if that starts to keep going, then you have major problems. So again, like everything in uranium, it just takes a little bit longer.
And do you think Trump might reverse the ban?
I think it would take Congress to do that. I think it took Congress to put it in, and it would take a lot of work. I'm sure there are some fuel buyers. I know there are some fuel buyers who want it to happen, obviously, and think it will happen, and just think, well, Trump will come in and he'll do it. Okay, well, good luck with that. We'll see. But again, that too, I take it all the way back, whether it's banned or not banned. Jesse, the deficits, to put them in context, as we look structurally, looking out over the next 5, 7, 10, starting now, it's already in deficit. But you're talking depending on the level of enrichment levels you use to determine how much uranium requirements there are, and I won't go down that rabbit hole, but there's some flex there. But you're talking anywhere from 15 to 20 to 35 to 50 million pound deficits per annum. So whether enriched uranium comes in from Russia or not, and it causes hysteria in a shipment, that's not the story. that's headlines and people looking for a reason. Everyone tends to look for a reason as to what's going to be the catalyst. The catalyst is the fact there's not enough economic uranium. The requirements are low and inventory levels around the world are low. The US is sitting at around a little over 2 years. The Europeans are under 3 years. Those are the comfortable levels for them. We often hear about Chinese inventory levels that they have 15, 16 years of inventory. Yeah, right. And in other commodities, they have 50, 60, 70 years of inventories. And in that scenario where you're looking, the Chinese right now, if you look at what they're going to consume, if I think about China's consumption in 2025, it's going to be 40 million pounds. In 2030, it's going to be 65, and in 2035, it's going to be 80 million pounds. They only have access to, could source internally, everything else, 20 to 25 million pounds. So and when you look on a rolling 3-year basis, a rolling 5-year basis, if you take their cumulative needs on a rolling 5-year basis, that 16 years compresses down to 3. So we argue, just to maintain their existing, if they maintain their purchasing level at this level, they would need to buy something along the order of 140 million pounds a year by 2030. Let me put that in context. 140 million pounds a year, that's out of a 200 million pound demand number. The industry forecasters would use less, but we're comfortable using 200. And on a supply number of 150 million pounds, 160 million pounds, if China kept at that level, if they said, okay, you know what, we're gonna go down to 10 years of inventory, you're still looking at 10 years of inventory. You're still looking at probably 60 to 80 million pounds a year of purchasing. They have an enormous amount that they need to do because they are the largest reactor builder in the world. They have 30 reactors under construction right now. They're bringing on 8 to 10 a year, and for as far as the eye can see. So as we look at the inventory levels, we don't see where there's some loose pounds floating around. I'm not talking about spot market, 1 million or 2. There's always floating around there, but structurally. So that's my view.
And Justin, your thoughts on the uranium ban in Russia, how that can impact markets, and if you think that Trump will make an effort to reverse it.
No, I don't think that he will. I don't think he's even going to make that effort whatsoever, but he can't just reverse it, right? Because it's legislation, it's law. So there would have to be legislation introduced to reverse what is now law, banning this material and starting in 2028. And keep in mind, the legislation to ban this material was bipartisan and unanimous. So it would be a major, I would say, headline risk for not only the Trump admin, but everyone involved who signed this ban for the reasons that they signed it to all of a sudden reverse course. I don't think the ban that's law in the United States is going anywhere. The embargo on Russia's behalf is set to expire at the end of this year. Whether or not they will extend that, we don't know. Whether or not Putin will reverse this as some kind of negotiation with ending the war. This is all total speculation. As of now, our understanding is there's 3 shipments that should have had EUP on it coming from Russia to the United States since they enacted this embargo, and I think it was late November, that have not had the material on them. So this is actually a disruptive event. But like Mike said, these things don't automatically cause immediate reactions in the physical market. And the uranium that would have been shipped to the United States can and will be sold elsewhere. China is going to buy up whatever we don't. So it's not like in this global marketplace, Russia will be able to sell what we're not going to buy from them into a different market. With that said, if there are some utilities, again, like Mike said, that are offsides on this, that we're expecting a delivery of EUP from Russia, they now have to cover off and go buy spot EUP if they can find it at their desired enrichment level, which is maybe they can, maybe they can't. If they can't find that, they have to buy spot enrichment, which is right now at all-time highs. If they buy spot enrichment, they have to feed UF6. If they can't find UF6, they got to try and buy spot UF6, which is barely none. It gets complicated all the way down the fuel cycle. So some of these utilities that may be offsides with these deliveries are going to have to cover off. We've already seen an initial reaction in the spot enrichment market from the first shipment that didn't arrive. I think right now, if I can gauge where utilities are sitting, and this is specifically U.S. utilities and or other utilities that are being affected by this ban. So there's some other utilities that we're expecting EUP to be delivered from Russia to the United States to be fabricated to fuel here and then shipped elsewhere. Prime example was a Mexican utility that's missing their fuel load for March, right? Because of this delivery that was missed back in early December. So a lot of these utilities, in my estimation, are kind of sitting back right now going, okay, this is a problem. And we've been focused on this problem for the last 2 years. And even UXC, that basically, they produce material for the utilities on behalf of the utilities, essentially, have been warning them, okay, all of this ban is in the works in the United States, but at any moment, Russia could just cut it off. And they've been saying this for 2.5 years. Well, finally, they did it. And any utility that hasn't had a contingency plan is going to have to act in the market. But again, this is sort of a shiny object. The big picture, long-term, stable demand growth, undersupplied market. This is just one of those elements that is another example of supply has to be diversified. You have to focus on security of supply. And any utility that has to cover off and to buy spot enrichment, they're going to have to scramble into the uranium and the conversion markets to get that material through the fuel cycle quickly. Last point I'll make is that Russian enrichment contracts have return feed requirements. So a utility that might have had a delivery disrupted from a Russian enrichment contract may not have already purchased their uranium in conversion or UF6 to feed to the Russians. So if they have to cover off by contracting spot enrichment from Urenco or Orano, they have to provide feedstock up front. So that could cause some accelerated demand. Again, I'm not expecting this to be an overnight moonshot, but it is a detail in this overall big picture of a problematic supply market with very, very firm and rising demand.
Let's talk about Kazatomprom for a moment, because the story from uranium bears over the past few years has generally been, well, Kazatomprom can just ramp up production and bring prices down. We've seen them now miss production targets for 2025. It looks like there's an issue with their joint venture with Cameco, apparently due to paperwork not being filed in time. We'll have to see how that all plays out. But Kazakhstan is obviously in a very interesting geopolitical situation due to their close proximity and deep relationship with Russia. Do you think we could eventually see Kazatomprom decide that they're going to commit to supplying the vast majority of their uranium to either just Russia and China, the BRICS nations, kind of in this bifurcated situation we're seeing geopolitically? Do you think that could play out? Is that a possibility? Mike, I'll start with you.
So I think, yeah, you've already seen the Chinese, Kazatomprom voted, the shareholders voted to supply more than half their uranium to China. They have a warehouse right at Alashenko on the border. I think you see the joint ventures there forming that triangle of an alliance between the Russians, the Chinese, and the Kazakhs. The Kazakhs have been Western facing to the extent that they independently can continue to do that is anyone's guess. They're in a tough seat, right? They have a nice endowment of uranium. I do think that geopolitically their allegiance would turn east. And so it's two-pronged with Kazatomprom. They've shown very good discipline in the early years of the real downturn, or in the latter years of the real downturn, they were the first ones to pull supply off the market in 2017, right? Think about that. A state-owned entity, when the price was at the bottom, said, we can't make enough money. So we're going to show value over volume, right? So that kind of throws conventional wisdom out the window as to how a state-owned entity would act. Then as we've moved forward over the years, if you look at their original prospectus in 2018, it was pretty clear, and they lay it out with beautiful, pretty graphs and stuff like that, as to how in the late 20s, early 30s, their resource falls off a cliff unless there's significant investment that goes into that to develop those. And fast forward, what we've seen since then is the goals that they have laid out in there for producing, they call them subsoil use agreements, they've fallen mostly 20% per annum short of that out of supply discipline, but more recently, it's out of supply challenges. Problems getting the sulfuric acid to do it, and just problems in general in bringing things online. So, for the Kazakhs, we think will turn east more likely than not. They already have half of their pounds are going to China. So that's we'll make a pretty big bet on that. We would say that's the case. And then just in terms of the bears, and we heard somebody said to us, well, the Kazakhs, they increased production 8%. How is that not bearish? Well, that was last year's, for this year's numbers, but it was still way below what their target was. But that taken in, just because the biggest producer ramped it up a little bit, you have to take it into context of overall production. And overall production is woefully short of overall demand. So, yeah, I think Kazakhstan is still obviously a very, very powerful producer. But, they're 60 million. Originally, they were going to do 80 million pounds a year for through the latter part of the 20s, and then it started to fade. Now you're looking at the 60, 63, 65 million pound a year range. They have to spend a lot of money to be able to do more than that. Money that's challenging for them.
And Justin, your thoughts on Kazatomprom, whether they could potentially cut off uranium supplies from the West?
Cut off is kind of a strong word. I think there's plenty of evidence to suggest that they're already moving in that direction. Not of cutting off, but just basically selling more and more of their material on a 100% basis and on a Kazatomprom personal basis. More of that material is going to the east, specifically to China. We've seen two very large contracts with Chinese utilities in the past 24 months with Kazatomprom. We've seen a couple of joint ventures be swapped between the Russians and the Chinese. We've seen just more and more investment in that area on behalf of those two entities. So that is, the writing's on the wall where more and more of the material coming out of Central Asia is going to end up. And it's no coincidence that the largest builders of nuclear in the world right now are the Chinese, and they're going to do what they can to procure as much of the easy uranium from their neighbor as they can going forward. And the Chinese are going to be net buyers. They have big inventories, but those large commercial inventory numbers, that's not just what's available to the Chinese utilities or the Chinese traders. Like, these are sovereign strategic inventories. In some cases, military numbers are probably mixed in with those numbers. So the Chinese, they don't really sell uranium. They'll trade a little bit here and there. And of course, they'll engage in contracting activity. They've sold a little bit of enrichment, but mostly that's been what they've been buying from Russia. But it's relatively small volumes. They are net buyers in a major way for as far out as we can look into the future. So anybody thinking that Chinese inventories are going to save the day on the supply side is completely ignoring how the Chinese operate. Going back to what's going on in Kazakhstan, it's I don't want to get too deep into the weeds here or sound conspiratorial, but Inkai is the best ISR project in the world, and this is almost a 30-year partnership between Cameco and Kazatomprom. So to see their production down 20% year over year for the first half of last year, followed by this latest hiccup, and still the halting of the project, to our understanding, is continuing. Then we see CGN's numbers come out last night as well, and their production was down year over year for last year also. So we think Kazatomprom, when they report, early February, in a couple of weeks here, they're probably going to come in on the low end of their range for 2024. Maybe they miss. I'm not making a big bet on this, but it's probably going to be in the lower range. Will they revise their 2025 projections, which is, I think, we heard last August, correct me if I'm wrong, Mike, I think it was 25 to 26,500 tons for 2025 is what they're projecting. So we're just going to have to look at their reporting, look at their numbers on their CapEx for the second half of last year. If the CapEx jumped in a major way and breached, let's say, the overall increase in cost, inflation generally, then we're going to know more money was put into the ground and more production is going to come out of the ground. You have a lagged effect of 8 to 12 months. When the cash goes in the ground, production increases. So we have to look at those numbers before we make a guess on what they're going to be doing for late 25, early 26. They're going to be able to continue to marginally increase year over year, But in order to, again, echoing what Mike said, they have a steep, steep decline in production in the early 2030s. In order to replace these projects that are already, some of these are in decline, and many more will be in decline in the next 5 years, an enormous amount of capital and an enormous amount of sulfuric acid are going to have to be utilized to even maintain production getting into the 2030s, let alone even come close to their projections from only a year ago of hitting 30.5 to 31.5 thousand tons. It was supposed to happen this year. Obviously, that's not happening. So they're the 500-pound gorilla in the room. They'll be able to still produce consistently, probably marginally increase, but are they going to jump 20 million pounds in a year from this year to the next? It's just not going to happen.
So I was originally going to finish on discussing the main catalysts you see in 2025 for uranium, but I think we've kind of gone over a lot of those, and it's more about the long-term supply-demand imbalance. So instead, I wanted to maybe pick your brains about your own investment strategies in this space while avoiding talking about any individual equities. I'm just wondering, because Mike, you brought up an interesting point in that it's difficult to evaluate a lot of these companies. You can't look at their financial statements in the same way you could, as you mentioned, an oil producing company that has cash flows and all these types of things. You can't use a lot of the traditional valuation metrics. So I'm wondering, from your standpoint, when it comes to the different areas within the uranium sector, the big producers, of which there's only a couple publicly traded, Cameco and Kazatomprom, the developers who are working towards putting a mine into production, and then the explorers. How do you view that landscape? How do you allocate capital? Do you position size so you're more heavily in the more so-called surefire bets, such as the big producers or physical uranium? I know, Mike, that your fund actually purchases physical uranium, but there's also SPUT for retail investors out there, the Sprott Physical Uranium Trust, as well as Yellow Cake PLC in London. How do you both kind of strategize your approach to the sector, breaking it down in those different buckets? How do you deploy capital? And how do you evaluate these companies that aren't really producers? Justin, I'll start with you on this one.
Well, I think that Mike and I will probably have some overlapping ideas and probably have some pretty differing ideas because he manages money and we read a newsletter. So our strategies are going to be different, but in some cases, I think that they might overlap, which is, we like to focus on real companies. That is to say, companies that we believe will be producing something, producing cash flow, producing returns for shareholders, at some point, if not now, during this bull market. And I think you can count on one hand, possibly getting into the second hand, of how many companies can actually do that and get over that line. I think that retail likes to try to shoot for the moon and call their shot and hit a grand slam by investing, putting way too many of their eggs into a single basket. Not only just a single sector, but a single company in a single sector. That is always very, very risky. So for most people, the ETFs are probably the way to go, if not just buying SPUT to play physical uranium, which, we're very constructive on continuing to move to the upside over the long term. So, our process, we look at management very closely. We want to understand what they've accomplished in the past and what their plans are for this bull market. We look at the share structure. We look at the overall liquidity, and we try to come up with some idea of what they'll be able to accomplish in the coming years that maybe the market isn't baking into the price. And that's kind of that X factor. It's a little bit more tricky to nail down, let's say, but we've had some big winners that have pulled off some nice moves in the past few years that will hopefully we'll continue to see that. I think we'll see more consolidation in the industry, which will be a good thing. But, we still, thus far in this bull market, we've seen basically an outperformance of the large caps, which is to say, the most liquid stocks have tended to perform better. We have yet to enter the phase of this resource bull market, which typically happens in pretty much any resource, which is the developers, the mid and small caps developer, and even at some point the exploration stocks that, the tiny caps with a little bit of moose pasture end up going on a moonshot. We haven't seen a very frothy, very enthusiastic and euphoric type moves in this market that moves everything in a really, really steep manner. So, and I think we will at some point. That's not necessarily our investing thesis, but at some point we should see a rotation of money That is to say, a more enthusiastic amount of capital coming into the space that's buying into the smaller and mid-cap names. So, and then just to say generally, last year was a huge year for the nuclear stocks and the utilities. I think there's a lot of value proposition here in uranium. When uranium starts to move, the equities are going to really, really move. And you can kind of feel that like bubbling under the surface right now. Sentiment is really bad, but the stocks are kind of hanging in there considering where the spot price is at and where it was a year ago. There is this underlying sense of optimism. There is this underlying sense of, okay, I get the thesis. You guys have said it a million times. Last year we got it. The big tech is in. It's growing. China's going crazy. All right, we get it. We get it. We need to see evidence in the physical spot market that the price is going to move in response to all of these fantastic fundamental pieces that are coming in through a fire hose. When that starts to go, everybody who capitulated in December or who just thinks this is over, they're going to be buying back in higher. We'll see a lot of momentum to the upside. So we generally see a lot of opportunity in uranium mining stocks this year, especially relative to how the nuclear and the utility stocks have performed in the last 12 to 18 months. With all of that said, as soon as this market starts to move on the physical side, and it's not going to take a lot of demand, Jesse, it's really a thin market. Any real demand in either the spot or the term market, when it comes, and it will, is going to move the price. And so that's what we're positioning for.
And Mike, anything you can share about Station Code's strategy when it comes to investing in the uranium sector?
So it's very, very fundamentally and valuation driven. You got explorers, you got developers, and you've got producers. But depending on where you are in the cycle, the one we'll have the least of by a lot is the exploration stage. We'll have a few sprinkled in here or there. Don't make particularly big bets on them. Not a geologist, not a mining engineer. No, play to your strengths, not your weaknesses. Interestingly, earlier on you go back many years now, it would have been almost impossible to make a case for exploration. It was hard to make a case for exploration. People were looking at $18 uranium and saying, what? You're going to explore for more? There's plenty of it. But times, you've got shortages now. So there is a case for exploration because you need to find new pounds. Probably, again, many of them are poking hopes, but there's some that are more interesting. You got to keep in mind they're going to dilute as they're drilling and drilling and drilling. And so you just got to figure that out. I don't have any advice for anyone to do that other than be really cautious, right? You could find one that's a home run or find many that aren't. We don't do much in the space. We do some, a little bit. On the development side, same thing. Everything with these companies, we're laying out the life of the mine, and we're looking at what we think it's worth and what a multiple it would get and what the net present value is. And when we think that the asymmetry, sometimes these stocks have big moves and it might collapse the asymmetry, and then we'll rotate that money into something else. So I want to be clear. I am not a perma-bull on uranium. I am not a perma-bull on nuclear. These are cyclical industries. This will have its day where you can't own any of them. There will come a price where it's not asymmetric. At least that's how I view it. And so I'm really guided by where I think the risk reward is. It could be at certain times in the development stage. It could be at certain times in the production stage. When you're thinking about producers, you have to think about scarcity value. Justin mentioned earlier, it is really hard to build a uranium mine. It's really hard to get one restarted. So that's where the art of investing comes versus science. Is what multiple is the market going to assign that scarcity value of those who are already doing it, of those who have huge head start, barriers to entry. So, but there is if we have producers, we have developers, we have other some exploration. I always say we're not getting paid to figure out what to buy. We're get paid to figure out when to sell. And because the theme is compelling and it's there, but we figure out what to buy. But like I said, there will be, I think it's a long, I'm not going to say timeline. I don't know what the timeline is, but from a risk reward standpoint, I think we're a long way away from thinking that there's no value there because we think there's significant upside to it. I don't talk individual names, but yeah, but if you looked at our producers' names, you wouldn't be surprised, right? And then it comes down to sizing, and I think it is very important to understand that volatility reigns supreme in this space, and you could have breathtaking moves both directions. So you got to be just sized to what your stomach can handle and what your risk appetite is. It is because when it goes down pretty quickly and swiftly, and sometimes there's no place to hide.
Well, gentlemen, this has been a fantastic conversation. So many fantastic insights shared. Before I do let you go, Justin, tell us about uraniuminsider.com and what it is you do there.
We're 100% focused on the uranium industry. So we've got a small team. We've been doing this since August of 2019. We've done quite well so far. We see still a lot of runway left in this trade, and oftentimes that market volatility that Mike just highlighted will give you second and third and fourth chances to to size into positions at lower valuations. And I think that we're kind of in one of those chances right now, just like last summer. We put out a very lengthy monthly newsletter. We do members only webinars once a month. We put out weekly watch lists. We cover the physical market and communicate on almost a daily basis with our membership. And we basically just try to take all of the very difficult to understand convoluted elements of the physical market and the uranium trade in general and distill it down to what you need to understand from an investment standpoint.
Fantastic. I'll put a link to uraniuminsider.com in the description. Mike, I believe Station Cove is not a fund open to the general public, but for people who do want to hear more from you, is there anywhere they can go? Is it mostly through interviews like this? I know you do interviews on a lot of these shows. Is that the best place to hear more from you?
Yeah, pretty much. Yeah, I'll speak or something when I speak on a podcast or something. I mean, yeah.
Great. Well, search Mike Alkin on YouTube. There's plenty of interviews out there. You've done some great ones, including with my good friend Lucian at Triangle Investor, Money of Mine. You had a fantastic interview on there recently. So I do recommend people check out more of your work and your expertise. And thank you to both of you once again for coming on and talking uranium.
Thanks for having me, Jesse. I enjoyed it.
It's been a true pleasure. Thank you again.